You did everything right. You bought the house. You funded the 401k. You trusted a story about pillars of security in a chaotic world. You look at your statement today. The numbers are stable, even up, but you are looking at a ghost, an empire made of paper, and the ink is starting to run. In 2026, the great transfer of wealth will not be a crash, not a siren you can hear. It will be a silent revision, inside the legal framework of the assets you were told were safe. They are not stealing your money. They are replacing it with a hollow promise, the same name, none of the value. This is not inflation. This is the great unraveling. The first illusion to shatter is the myth of intrinsic value. You believe your house is worth $1 million because Zillow says so, because your neighbor sold for that much. But that market value is not a measure of the house's utility. It is a function of cheap credit and market sentiment. It is a liquidity premium. In 2026, as central banks are forced to contract, that premium will be withdrawn. Your house will still be a house, but its ability to be converted into $1 million of purchasing power will evaporate. This is the silent default. The asset doesn't crash. The liquidity that gives it value simply leaves the building. Your 401k is not a vault of cash. It is not a pile of gold with your name on it. It is a collection of digital claims, claims on future corporate earnings and future government tax receipts. But in an era of debt-funded stock buybacks and governments printing currency to service their own bonds, you are not investing in real growth. You are a creditor to a deeply unstable system. You are buying their obligations with your future. The great unraveling is the moment the buybacks can no longer be sustained. The moment the numbers on your statement become ghosts, hollowed out from the inside. You believe you own your stocks, your index funds, your digital assets. You don't. You own a beneficial interest, held for you by a custodian, a broker, a bank, an exchange. Read their terms of service, the fine print you agreed to. In a systemic crisis, your custodian has the right to halt withdrawals, to liquidate your position, to use your assets to save themselves. The stress tests of 2026 will prove you do not have a property right. You have a permission slip that can and will be revoked. This is the custodial trap. You own the claim, but they own the exit. This is the hidden engine of the unraveling, a word you were never meant to hear. Rehypothecation. When you pledge your assets as collateral, the law permits your broker to use those same assets as collateral for their own loans and trades. This creates a chain of ownership claims on the same underlying asset, sometimes 10 or 20 layers deep. It is a skyscraper of paper claims, built on a single brick of real value. In 2026, when one link in that chain breaks, the entire skyscraper implodes. Your asset, safe in your account, now trapped in a legal black hole of counterparty failure. You didn't lose the asset. You discovered it was never truly yours. They gave you a signal to watch, a comforting academic indicator, the yield curve inversion. They told you it predicts recessions, a warning of a coming storm. But in the new economy, it is a rear-view mirror, a signal that tells you about a danger you have already passed. The real signal, the one they do not discuss on financial television, is the ratio of corporate debt to GDP. It is the true measure of the system's fragility. While the world was obsessing over the shape of the curve, the corporate debt mountain grew to an unprecedented size. The old signals are not broken. They have been rendered obsolete. A masterful distraction designed to keep your eyes off the real cliff edge. For over a decade, with interest rates near zero, corporations went on a debt binge. This debt was not used to build factories or to fund research. It was used to buy back their own stock, artificially inflating share prices and executive bonuses. They traded real balance sheet health for a temporary sugar high in the market. This has created a landscape of zombie companies, firms that do not earn enough profit to even cover their own interest payments. They only survive by taking on new, cheaper debt. In 2026, when cheap debt is no longer an option, the zombies will collapse, and the pension funds and 401ks that hold their investment-grade bonds will be the first casualties. But your accounts are insured, you tell yourself. Government deposit insurance, investor protection funds. You see the official stickers on the bank door, a promise of safety. These acronyms are your safety net, but they were designed to protect against isolated failures, not a systemic unraveling. These insurance funds are a glass of water, designed to fight a forest fire. The total amount they hold is a microscopic fraction of the paper value of the assets they claim to protect. They are not insurance. They are a psychological buffer, a placebo, designed to maintain public confidence in a system that is fundamentally uninsured against itself. In the hyper-connected financial system, there is no such thing as an isolated failure. Every asset is someone else's liability. When the first major zombie corporation defaults, the pension fund holding its bonds becomes insolvent. The fund is then forced to sell its other, safer assets to cover its losses. This fire sale drives down the price of those safe assets, putting pressure on another fund, which is then forced to sell. This is the contagion, a domino effect that moves at the speed of light through the digital plumbing of the financial system. This is the end game, deleveraging. It is a sterile academic term for a brutal, chaotic process. It is the system being forced to purge the decades of excess debt it has accumulated. All the paper wealth that was created out of thin air must now be destroyed. Assets are sold not for what they are worth, but for whatever cash can be found. Credit markets freeze. The velocity of money grinds to a halt. This is not a recession. It is a system-wide margin call. The tide of artificial liquidity goes out, and for the first time in a generation, we will see who was swimming naked. The unraveling is not a drama on a stock chart. It is a quiet force that hits the real world with brutal efficiency. It is the small business that can no longer secure a loan to make payroll. It is the major construction project that halts overnight, leaving a steel skeleton against the sky. It is the retiree whose pension is cut by 40% with a single sterile letter. It is the sudden, jarring realization that the paper wealth you used to plan your entire life was never real. The numbers were just a story, and in 2026, the story is over. In the chaos, there will be a flight to quality, but not to the quality they sell you on television. It will not be a flight to government bonds, which are the very source of the systemic risk. It will be a flight to things that cannot be printed, rehypothecated, or defaulted on: productive land with water rights, monetary metals, key energy resources, and most importantly, non-digital real-world skills that solve critical physical problems. Assets that have value independent of any financial system. The unraveling is a process of separating the real from the illusory, a painful but necessary return to reality. The ghost panics. He sells his paper assets for other paper assets, hoping to catch a falling knife. The architect understands the entire game is flawed. He does not try to win it. He prepares to survive it. The architect's mindset is not about timing the market. It is about ruthlessly reducing counterparty risk. It is about asking one simple question for every asset you own. How many other entities, people, or institutions must remain solvent for this asset to retain its value? If the answer is more than zero, you have identified a point of failure. The great unraveling will be painful, a harsh winter for those who built their lives on the hollow promises of paper wealth. But it is not an apocalypse. It is a necessary reset, a cleansing fire that burns away the artificial to reveal the real. On the other side of this process is a world where value is tied once again to reality, not to a central banker's keyboard. It is a harder world, but a more honest one. At After Decision, we do not fear the unraveling. We document the path through it. This is After Decision.